In today's video, we'll be breaking down the 80-20 rule in accounting, also known as the Pareto principle, which states that 20% of the work that you do will deliver 80% of the value that others perceive. So if you master the skills that we'll be discussing today, you'll look like a pro way ahead of your title. If that sounds good to you, let's dive right into it. Welcome to another video with your favorite financial controller, Bill Hanna here. In today's video, we're discussing the 80-20 rule in accounting. So in accounting roles, especially in corporate accounting roles, there are a few high leverage skills that if you master, it will give you an edge over your peers. So these skills are going to be closing the books, number 2, reconciliations, and then financial analysis. So in today's video, we'll be going over these skills one by one, providing an example of each one, and giving you some references and other material you can review to master each of these. So let's dive into the first one, which is closing the books. So when we're talking about closing the books, what we mean here, the easiest way to explain this is that in any organization, we have day-to-day transactions, and we have month-end activities. So what do we mean by day-to-day transactions? Well, that will include billing, it will include payroll, accounts payable. You also have employee expenses, equity transactions, consolidations, but these are the core ones. Billing is how we make money. Payroll and accounts payable is mostly how we spend the money. And the month-end side, what we have is going to be accrual adjustments to revenues and expenses, account reconciliations, and financial statement analysis. And to be able to put all that together for the month-end close, typically what you'll do as a capable controller is create a checklist of your month close activities. So let's go ahead and take a look at an example of what that checklist will look like. So here's an example of a master period end accounting close checklist. I'm going to leave this file here in the description of the video so you can download a free copy of it. But let me walk you through the main things you need to know about creating a checklist. So typically, a checklist would include routine transactions and then non-routine transactions. What we mean by routine transactions, we're talking about the normal things like billing, accounts receivable, accounts payable, credit cards, employee expenses. And when we look at the non-routine transactions, we'll find things like accruals, so revenue and inventory accruals, fixed assets, other accruals, reconciliations, so on and so forth. Now, for each of these categories, we create a type of transactions, and then we have the close activity itself. So for the first one, for example, we have billing and accounts receivable, and the close activity is compare, for example, warehouse shipments to invoices. And this is typically something you do to ensure completeness of your invoices, is comparing the shipments from the warehouse to the invoices that were created in the system. We should create a column for timing. So for example, here in my organization, this is completed on working day 2. You should consider your organization and the timeline that you have and select the time frame that works for you. For me, it's working day 2. Now, typically you put in someone who's responsible for this task. So here, prepared by is going to be Jake, and then reviewed by is going to be Marla. And I'm going to have a column for the status, and that's going to tell me whether it's done, in progress, or not yet done. Right. As you go down the list, these are all the activities related to the routine transactions. Then we get to non-routine transactions, and these are the adjustments that you create at month end. So the checklist is just a way for you to organize all of the activities that you have to do to get the adjustments on the books and get the books closed. And if you're looking for a complete method to come up with the checklist for your organization, I made this video, I'm going to link to it up here, that shows you exactly step by step, starting from your financial statements and how to arrive at what should be on your checklist. Okay, again, this file is going to be available for download in the description of the video. Go ahead and grab a free copy. But this gives you a quick overview of what needs to get done to create a checklist for closing the period. Also, if you're enjoying my teaching style, which I think is the case here probably, go ahead and stop by the Controller Academy, where you'll find my courses, which are the only accounting courses that you'll find online that teaches you real-life hands-on skills while giving you CPE credits approved by NASBA. Go ahead and check it out. And now back to the video. All right, so we talked about closing the books. Now we'll jump into the second type of activity, which is reconciliation. Again, high leverage skills, reconciliation. The meaning of that is that you're looking at a book balance. So typically when you look at the balance sheet, and we'll look at an example here in a second, the balance sheet needs to have an external support, right? So this way you can trust that the number that you have in your balance sheet has a working paper or a support to substantiate the balance that you're looking at. Let's flip over to Excel and have a look and show an example of what we're talking about here. So here's a trial balance for a client as of July 31st, 2025. You'll see the various balance sheet accounts and then the various income statement accounts right below. So what we mean by reconciliation is ensuring that every balance sheet account, which goes pretty much from the beginning of the trial balance all the way to the end of the three accounts, these are the equity accounts, that each of these has a reconciliation. So typically for a bank account, so this one is Chase checking account, you'll perform a bank reconciliation. So the balance here is 3.249 million. You need to pull the bank statement from the bank website and create a reconciliation, typically done inside of the ERP, whether it's NetSuite, QuickBooks, or whatever you have. I made a video up, I'm gonna leave a link to it up here, on how to perform a bank reconciliation. Go ahead and check it out after watching this video. You'll go down the list and create a reconciliation for all of these accounts. Let me show you an example reconciliation for one of the accounts here, deferred commission. So to create a reconciliation, the first thing you need to create is a cover sheet. So I have a tab here called cover, and then I list the account number, the name of the account, and the description. So this way, if somebody opens up my working paper, they know what I'm talking about in this paper here. So this is a reconciliation of deferred commission. I'm listing the month end. This is July 31st, 2025. And here's the reconciliation itself. So the reconciliation has a beginning balance of the account, and I'm linking here to the working paper. So my beginning balance is 36,147, which if I flip over to my working paper, I have a beginning balance here for the period of 36,147, right at the end of June. Now my activity is going to be here, $1,446, which also ties to my working paper. And then the ending balance for the working paper is going to be the summation or the subtraction, because this is an amortization. The ending balance is 34,701. And then I link to my trial balance, and here's my balance per the trial balance, 34,703. And then I show a difference. You typically want that to be zero, but in this case, it's only $2. And I have here a policy that says anything below $10 difference, you wouldn't be investigating, right? It's immaterial to investigate. So this is what we mean by reconciliation. If you're looking for a bigger video on explaining balance sheet reconciliations, I'm going to leave a link up here to a video that I made on the entire process of balance sheet reconciliations. Okay, let's go back to our list. So we talked about reconciliations and how we do them, but it's important to note why we are doing them. So the purpose, there are four main reasons. Number one, it gives the controller and management reasonable assurance that the balances are correct. The second reason is for compliance. Mostly for publicly traded companies, to comply with regulations, you need to be reconciling all of the balance sheet accounts. The third one, it's a good control and oftentimes helps detect fraud. So think about it, if someone is entering transactions in a specific account and then someone else is performing a reconciliation, this is a good chance if someone is embezzling funds or hiding money for someone else to catch it in this process. The fourth reason, and probably the most important, is that it uncovers unrecorded activity that was forgotten or neglected, which hedges against prior period adjustments. And we all know this is the nightmare for every accountant, is having to open a previously closed period to make an adjustment just because there was a forgotten transaction. So all of these reasons are just highlighting the importance of reconciliations. Again, another skill that is very high leverage, meaning the effort isn't very high, but the impact is extremely high. All right, let's jump in and talk about the third item, which is the financial statement analysis. When it comes to financial statement analysis, there are two main types of analyses. The first one is an accounting one, and the second type is a financial or managerial analysis. The accounting analysis, the purpose of it is to find accounting anomalies. So you're looking for mistakes. You're looking for things that are unusual in nature in the accounting booking so that you can correct your books. The second type is a financial or managerial, which helps make business decisions. When it comes to accounting analysis, the most common one is going to be month-over-month flux analysis, which just takes the prior period compared to this period and come up with the percentage change so that you may know what are the main numbers that are changing and why they are changing. And I'll show you an example here in a minute of what I'm talking about. So with the financial or managerial analysis, there are three types: actual versus budget. And I made a video actually recently on that. I'll leave a link to it up here where it includes the entire process of actual versus budget. The second type is going to be a vertical analysis, which compares all of the line items on the income statement to one number, which is the revenue number, and shows each account on the income statement as a percentage of your revenue. The third type is a ratio analysis, which includes things like gross margin ratio, operating margin, current ratio, quick ratio, and many of these types of ratio analyses. Now, let's jump into Excel and take a look at the main types of analyses that I use on an ongoing basis to detect anomalies in the business and also provide business insight. Okay, so remember, we said there are two main types of analyses: an accounting analysis and a managerial analysis. This is an example of an accounting analysis of a compensation section of the income statement. And again, the purpose is to find accounting errors. The timing of this is before period close, and the audience typically is a controller or a VP of accounting. So we have here the category, which is salaries and other compensation items. We have month-over-month fluctuation, and then we'll create a column for the change. And then we'll create a column for the change percentage. So for example, here with salaries changed month over month by 2%. So to make sure that we don't have an accounting error, we will check the headcount report and confirm that the fluctuation is because we hired 2 new employees in December of 2024. So you see, there is a reason why the number went up by 2%, and the reason is that we hired 2 extra employees in December. So that gives me more comfort that the number is correct for the month of December. So that's what we mean by an accounting analysis. Now let's flip over to a business analysis. And by the way, this file is going to be also available for free download in the description section of this video. So for a business analysis, we'll be doing the same thing. We'll be comparing December to November. We'll create the change. However, in the commentary, we are now commenting on what's happening in the business more than the accounting change. So what we're saying here is that we hired 2 new employees in December in the sales department. So we're calling out what department this is in, and it is outlined in the budget. So that's the second thing we're saying, is that we checked the budget and we made sure that this extra hire is already in the budget. So this is a type of analysis that will provide an actionable item. So if these 2 hires were not in the budget, for example, that will trigger an action that we need to discuss with the department head, whether these 2 extra hires were something that was not planned for altogether, or do we need to adjust our budget going forward, or what the case is. So this is a business type analysis. So to recap, the 80-20 rule in accounting, or the Pareto principle, is that 20% of the effort will deliver 80% of the perceived value of your work. So that means you should really focus on these things. The first one we said was closing the books and creating a checklist for that. Number 2 is a reconciliation. And then 3 is the financial analysis. And that concludes today's video. If you found it valuable, go ahead and share it with someone else who might benefit from it, and hit the like button. And I'll see you in the next video.